My name is Lisa Hannum. I'm the managing editor at Money Sense, and today we're going to be talking with Brian Borzakowski. We're going to be talking about bonds and why we should not find them to be so boring, in his words.
Basically, bonds are there historically to balance out your portfolio. They're not that, I mean, generally, they're not that exciting because you are just buying kind of government bonds, and, you hold on to them for a while. I mean, most people can't buy bonds themselves. They buy bond funds. So they just put their money in a bond fund, and there's no big names. They're not interested in, you're not hearing about, all the companies. Now, there are um, uh, corporate bonds. But even then, when you're buying the bond of like a business, it's not the same thing, as it doesn't have the daily fluctuations in the same way that the stock prices do. Media doesn't pay much attention to fluctuations in the bond markets. They're just really there to kind of balance out your portfolio. When stocks tend to fall, bonds tend to go up. Bonds don't fall as much as stocks, so they're kind of just there in the background, just hanging on, and kind of helping your balance your portfolio. And that's why people don't talk about them that much. And I write a lot about investing, and bonds don't sort of factor in all that much on a regular basis in my journalism, which sometimes you sort of think that it should. You don't want to ignore that part of the market because it actually is a huge, very liquid, massive market. I mean, it's bigger than stocks. Like, there are a lot more bonds out there, and there's a lot of bond trading, and it's global business, and so it is actually pretty interesting, but it just doesn't get the same attention because it's just not on a daily basis. It's not as exciting.
What should we be watching for when it comes to bonds?
So there's yields and there's prices. Now, yields are the distribution you get if you hold a bond to maturity. You get a payment on, it could be an annual basis, on some sort of regular basis. And if you're, at the end of the term, you'll get the agreed upon kind of interest that you get for holding this bond. And so when the yield tends to rise, bond prices fall, and bond prices rise when yields fall. That's just kind of the relationship that they have. And so right now, yields are rising. And why that's interesting is in parts because there's, the bond market, again, is vast. So I'm going to break it down here. It's a little complicated, but we have the overnight rate. So the short-term rate is what gets the most attention in the news. That's the Bank of Canada. When they come and they get together, on a monthly basis, they are the ones that are talking about whether they should raise the overnight lending rate. That's the short-term rate, interest rate that banks loan to each other on like a nightly basis. Banks are loaning money to each other all the time on a nightly basis. That's the rate that they would charge. Now, that impacts mortgages, that impacts borrowing rates, lines of credit. So it gets a lot of attention. What's happening right now is that rate is very low, 0.25%, very low. That's like his ultra low levels, historically low levels that we've only seen in the recession in 2008, and we've seen it now because of the pandemic. So, and that's in the States too. And the Bank of Canada has said that they're not going to raise those rates until 2023. We'll see about that. But while those rates are low, you have the 10-year bonds. So these are bonds that you would hold for 10 years, 30 years. Those rates are rising, and they're rising by a lot. And I can't remember the exact number now, but I think in the story that I had, it was like, over 150%. So there was a rapid rise in these bond yields over a certain amount of time. And that has all sorts of implications. So we're getting to the exciting part here. There's all sorts of implications on the equity markets, on just people's psyche, on kind of what that might mean for the future. And so what people are saying now is the reason why they are rising is, in part, there's lots of reasons, but in part, one of the things that historically the bond market has done is kind of, in some ways, predict the future. They're looking forward-looking in the 10-year and the 30-year. So we're all worried about where's the economy going to go? Are we going to get these vaccines? Are things going to go back to normal? So bond investors are saying, yeah, the yields are rising because if you buy a bond now, you'll get a better interest rates kind of today in that they think that bond rates, if they are saying basically that the future is brighter, and that's why rates go up. If the economy was in trouble, bond rates would fall. That would raise bond prices. And so basically sort of the people in the space are optimistic about the future. That's why bond rates are rising. But there are some dangers there. And the dangers are that when bond rates rise, equity markets tend to take a back seat a little bit. And that is what we've actually been seeing lately is the markets have softened a bit because there comes a point where it just makes more sense to own bonds and which are less risky than stocks, and get the interest rate from that bond versus taking your money and putting it into stocks and risking, a market decline. So so there's potential there for your equity portion of your stocks to go down. I mean, the only problem with this is that the bond part goes down too when yields rise, because essentially what happens is the bonds that you have now at the lower interest rate become worth less. So you want to sell. I mean, this is the fund managers doing this for you. Most people aren't buying and selling bonds, but they want to sell that bond and they want to put that money into another bond with a higher interest rate. But why would someone pay for the lower rate at the full price? So your bond part of your portfolio goes down, your equity part of your portfolio goes down, and everybody kind of says, what's going on? So there's a lot happening here, but it is forward looking. And so the future, they're saying that the future looks, we're interpreting from the bond market that things are going to look better. The economy is going to pick up, and that is good news, which in itself could help equities rise.
Is there anything in your story that you also wanted to talk about?
This is why sort of people should pay attention to bond yields, is because one of the concerns that people have is inflation. Inflation is when prices rise too quickly. And generally, you want inflation to rise a little bit because you want people to earn a little more. You want prices go up. It's more expensive to buy stuff, but other people earn money, and sort of it goes through the economy, and everyone's happy and everyone kind of benefits. The problem is when inflation rises too quickly. So if people are if prices go up too fast, there's too much demand for something. Prices have been lower for a while. We haven't seen inflation for a long time. So if people start raising their prices, if the labor market gets tighter, now we haven't seen that yet, but if it gets tighter and people end up making more money and then start spending that money, the business could say, well, I should increase my prices because there's a lot of demand for my products. If you see that go too high, that is a danger because it overheats the economy, where then eventually people can't afford these things. And so they stop buying, or they buy now because they think the prices are going to go higher later. So that, and then ends up at some point, nobody's buying anything and the economy crashes again. Bond yields sort of are trying to anticipate inflation too. So if you see bond yields rise too quickly, and there's been some reports, I wrote this maybe a couple of weeks ago, and now there's even more concern about inflation than there was then. So if you see bond prices rise too quickly, they're sort of essentially trying to kind of catch up. They want to be a little bit higher than inflation because you want to earn something on those dollars, right? So if your money is not earning more than inflation, it's basically losing money. If you're earning less and prices are going higher, you can't pay for those things. So historically, bond yields will try and kind of outpace that. So if it goes higher too fast, investing's complicated. But if it goes too fast, too much, that's a sign that maybe the economy is overheating, inflation's rising, and that's not a good thing. And so it's just for sort of the average person, it's hard to make sense of this stuff, but it's something to pay attention to and just be aware of and understand kind of the relationship between bond prices and equity markets and bond prices and the economy. And none of this stuff's perfect. There's lots of, there's times in history where this sort of doesn't necessarily match up properly, where bond prices rise and the economy's kind of not picking up, but sort of over time, that's what we've seen. So it's just worth paying attention to.
Well, thank you so much for your time. It was great chatting with you.
Bye.